All right, let's talk about options and futures. You know, those super complex financial things that pretty much scream modern Wall Street. But what if I told you their real story has almost nothing to do with skyscrapers and everything to do with ancient olives and, get this, samurai warriors? I mean, if I asked you where stock options came from, you'd probably say Wall Street, right? It feels like some slick invention from the 20th century, something cooked up in a high-tech New York office. And yeah, that seems like the obvious answer, but it's totally wrong.
The real story? Oh, it's so much older and, let's be honest, way cooler. To really get to the bottom of this, we've got to forget Wall Street entirely. Instead, we're going to travel back in time, way back, to the bustling rice markets of 17th century Japan.
Okay, so we're about to head back in time. But before we dive in and meet the samurai who basically invented modern finance, we need to get a handle on the two key tools we're talking about. So, what are we actually dealing with here? First up, you got a futures contract. Think of this as a locked-in promise. You agree to buy or sell something, say a bunch of corn, at a price you both decide on today, for a date in the future. It's a done deal, no backing out. Then you've got a stock option. Now this is different. It's more flexible. It gives you the right, but, and this is key, not the obligation, to buy or sell shares at a set price. Here's a good way to think about it. A futures contract is like buying a non-refundable plane ticket. You're going on that trip. An option? That's more like putting a flight on hold. You have the choice to buy the ticket later, but you don't have to if you change your mind. All right, now that we've got that down, let's make our first stop. We're heading to feudal Japan, where the whole idea of a formal futures market really got its start. Okay, try to imagine this. It's payday, but instead of a direct deposit, your boss just dumps a bunch of rice on your desk. That was literally the reality for samurai. Their entire salary was paid in rice. So their income, their wealth, was completely tied to how much rice was worth. And that could swing like crazy depending on the harvest, right? One bad season and boom, your savings are wiped out. They desperately needed some kind of stability. So what do? Their solution was, well, it was pretty brilliant. They created the Dojima Rice Exchange. And this wasn't just some local market. No, this was the world's first ever formal commodities exchange. For the very first time, people could lock in a price for rice that would be delivered in the future. It totally changed the game, turning a wild gamble on the harvest into a steady, predictable income. You can really see the whole story laid out here. It starts in the 17th century with a big problem, samurai getting paid in super volatile rice. Then, by 1697, they've engineered this amazing solution, the Dojima Exchange. And that legacy, it's still alive today. That original exchange has evolved over centuries into what is now Japan's modern Kansai derivative exchange. And when you compare then to now, wow, it's just stunning. Think about it. The assets traded have gone from just one thing, rice, to basically everything you can imagine. Stocks, oil, gold, you can even trade futures on movie box office returns. The method went from people physically bartering in a room to instant electronic trades zipping around the globe. And the players, it's not just samurai and rice brokers anymore. It's this massive interconnected web of global investors. Okay, let's jump across the planet and fast forward a couple hundred years to the early 20th century. And it's a totally different vibe. While Japan was busy creating order and stability, America was diving headfirst into financial chaos. And this is where the modern stock option really enters the picture. But it didn't debut on some fancy, respectable exchange. Oh no, it showed up in these shady, unregulated places called bucket shops. And what were they? They were basically illegal betting parlors. You could walk in and just wager on whether a stock's price would go up or down without ever having to own a single share. And the undisputed king of this underground world was a legendary trader named Jesse Livermore. He pretty much got his start as a stock option bookie. Seriously, people would come to him, place a bet that a stock would go up, and he would just take the other side of that bet. His whole game was pure, unadulterated speculation. So, over time, these bucket shops evolved into something you've definitely seen in the movies, the classic boiler room. You know, think Wolf of Wall Street. These were just high-pressure scams where slick salesmen would call up unsuspecting people and bully them into buying stock in companies that were, a lot of the time, completely fake. And the scam itself was a classic pump and dump. Here's the play-by-play. Step 1. the brokers create a ton of fake hype and artificial demand for some worthless stock. Step 2, all that fake interest drives the stock price way, way up. Step 3, the company, which was either failing or just a shell, inevitably collapses. And step 4, the brokers cash out at the top and vanish, taking all the investors' money with them. Yeah, so this couldn't last forever, obviously. The amount of fraud and pure chaos was just out of control. Something had to give. It was finally time to clean things up and bring some real order to the market. And the answer, in a word, was regulation. To fight back against all the fraud from the boiler rooms and bucket shops, the U.S. government started setting up formal, regulated exchanges. The goal was to create a system that was actually structured, transparent, and, not a complete scam. And all of that led directly to the system we have now. It's anchored by huge, legitimate institutions, like the Chicago Board Options Exchange, which is the biggest options market on the planet. And to keep everyone honest, a whole team of watchdogs was created. You've got the SEC watching over the stock market, the CFTC handling derivatives, and if things get really criminal, the FBI steps in. And all of these powerful groups, they really all share one single number one goal. And that goal is simple, to create a level playing field for everybody. The whole point is to stop illegal stuff like price fixing and secret deals, to make sure that the average person investing their money has a fair shot and isn't just playing in a game that's rigged from the start.
Okay, so we've gone on quite a journey, right? From samurai just trying to get a stable paycheck to this massive, global, highly regulated system we have today. So, why does any of this history matter? What does it all mean for us, right here, right now?
Well, the market we live with today is a direct product of this whole story. On one hand, it's more accessible than it has ever been. Electronic trading means pretty much anyone can get in on the action. It's standardized, it's global, but there's a flip side. That incredible interconnectedness creates brand new dangers. A financial crisis that starts in one country can spread across the entire globe with terrifying speed, creating huge risks that those samurai traders could never have even dreamed of. And that really brings us to the core idea here. When you peel back all the layers of technology and complexity, the tools have evolved, sure, but the fundamental human needs driving all of this, they haven't changed one bit. It's still all about managing risk and seeking out opportunity, same as it ever was. Which brings us to one last big question. Remember, these tools were born from a simple need for stability. But when you look at today's hyper-fast, interconnected markets, do you think they still create that stability? Or have we built something so powerful and so fast that it actually creates more risk than it solves? Now that is something to think about.